Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Massud Ghaussy. He's a senior analyst with Nasdaq IR Intelligence with his 2020 small cap outlook and everything in between. Will 2020 be the year of tug of war? Massud, it's great to have you back with us on Trade Talks. And we have a lot to get through going into earnings season. CapEx and earnings growth. It was a little bit light with CapEx in 2019. What does that translate to into earnings?
So I think the story of 2019 was multiple expansion. Earnings were flat. Multiples expanded as a result of easy money. Going into 2020, earnings are expected to grow 10%. CapEx levels have fallen in 2019 as a result of uncertainty. But with economic growth kicking back in as a result of trade tensions coming to a resolution, we should see CapEx levels starting to go up again, while dividend payments and corporate share buyback levels probably will not accelerate as much. So what happens with that is it lays the seeds for future growth. 2020, we should expect at least 10% growth, and 2021 and beyond, perhaps some more growth as a result of strong economic growth and companies deploying capital into R&D and capital expenditures. And finally, one last point on this note. According to Bank of America's fund manager surveys and various articles in the press right now, I think investors want companies to invest into growth as opposed to what's called financial engineering, share buybacks, and dividend hikes. So again, the landscape, I think, is ripe for growth in the future, both in terms of the corporates and also the economy.
All right, well, certainly if you want to justify those valuations, you're going to have to show some growth. Let's move on to monetary policy, because one thing you've been speaking on is the strength of the U.S. economy. Monetary policy, super dovish in 2019. Do you expect that to continue in 2020?
So 2020, I think, will be a tug of war between economic growth and a monetary policy tightening. In terms of economic growth, the biggest headwind we had in 2019 was trade tensions and the disruption of global trade flows. With trade tensions coming to a resolution, that biggest headwind is no longer there. So as a result, we should see economic growth kick back in. And the reason it should kick back in is because of the tax cuts of 2017 and deregulation. If you look at Calvin Coolidge, JFK, Ronald Reagan, and George Bush, every time they enacted big bold tax cuts, it has ushered in multiple years of strong economic growth. 2019, towards the last half, economic growth was averaging around 2%. Historically, since World War II, economic growth is around 3.3%. Now, I believe with trade tensions no longer there, the incentives are in place for at least the economy to kick back into historical averages.
All right, especially with that CapEx growth.
Great, and going back to your monetary policy question is, once economic growth starts to kick in, I'm expecting monetary policy to tighten. The reason being, in 2019, the reason why central banks and Federal Reserve have pivoted towards becoming more dovish was because of slowing global growth as a result of trade tensions. So with all that reversing, central banks and the Fed should be once again start tightening. And especially to your point, with valuations, forward P of the S&P 500 at 19 times, and approaching historic times, the central bankers will definitely look at asset inflation and will need to start hiking rates again.
All right, we've heard a lot about large cap growth, momentum, and so forth, not so much about the small caps. What's your outlook there for 2020?
2019, small caps underperformed the large caps, reason being the small caps were more susceptible to trade tensions, where the large caps were more diversified and was able to basically cushion the shock from tariffs and disruption of global trade flows. As easy money continues, we should see investors moving to riskier corners of the market. This includes small caps, and emerging markets. Having said that, again, with trade tensions coming to a resolution, I believe it will be a good time for small caps. The only risk with small caps is, again, monetary tightening. Given their higher beta nature, they may be more, again, susceptible to a monetary tightening. So we should definitely see a period of volatility, but I think the outlook in the long run is very positive.
All right, speaking of volatility, and to wrap up here, election year volatility. I think 2016 was a little contentious. I think 2020 is really going to lend to some volatility. What do you think?
So it really, again, depends on who's at the White House and the structure of Congress. So there's a lot of question mark there. If the current structure remains, I don't think there will be a lot of volatility. However, if there are changes in the makeup of the Senate and the White House, then I believe there would be some volatility as markets will start pricing in new and different policies that are being pushed forward by the other side currently.
All right, Massud, great to see you as always.
Thanks
so
so
much
much,
for joining me. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.